looking into 2026 and deciding what, coverage level products a producer should be taking will definitely vary since it isn't a one size fits all. But like we stated before, with some changes in premium support for some county products, I expect many to take advantage of those options here in 2026. Before making those decisions, you need to know, how your farms trend with the county, what that county expected yield is will also play a role in this decision. With cutting costs being top of mind for many, keep in mind insurance most likely is your lowest cost and typically under 5% of your total cost per acre. That being said, I encourage you to keep your individual coverage at an effective level because that is your farm coverage.
Welcome to Compeer's Ag Edge, brought to you by Compeer Financial. In each episode, we break down complex agricultural economics, policy dynamics, and farm business topics into conversations that make sense for your operation. We're here to help you stay informed and confident about the trends and decisions affecting your agricultural business.
Hello, everybody. Welcome to the Compeer Ag Edge podcast. Today's edition will be crop insurance focused. And here with us is the product strategy team. I'm Cole Patrick, the Director of Insurance Products, and joining me is our state product officers and livestock specialist, starting off with Mike Bowen.
Hey everybody, Mike Bowen here. Happy to be here.
All right, next up we got Brandon Pezanoski.
Yeah, Brandon Pezanoski here from Illinois.
And lastly but not least, Michelle Sell.
Hello, this is Michelle Sell coming from southern Wisconsin.
Okay, there you have it. Some of the sharpest tools in the Compeer toolbox coming to you. The time of this recording is 1 p.m. on October 14th. And it is our favorite time of year. No, not because it smells like the pumpkin spice lattes. No, not because it's deer season. No, not because it's football season, but because it smells like money as the combines roll through the fields. And today we are going to cover a range of topics from the current state of the ag industry, some weather, some markets, some risk management, and then some product strategy and livestock. So with that, let's get right into it, guys. Starting off, industry, big take. Some of the most recent developments here that's affecting our farmers is the big, beautiful bill, which was a tremendously big package for agriculture, right? So that package was about $66 billion. So a lot of that went to our Title I programs, but for the more common names, ARC, PLC programs, and then a really significant portion went to crop insurance itself. So what are the most significant changes that came out of the big, beautiful bill? Well, we'll break it down into 4 major changes, right? One of those is going to be ARC PLC. One of those is going to be beginning farmer rancher. And probably some of the most notable changes with respect to crop insurance are the premium support lifts for products such as ECO, MCO, SCO, and all across the board crop unit subsidies. And to put that in layman's terms, ECO, SCO, those are supplemental products that are area-based. We'll get into it a little bit later, but the premium support for those did increase from 65% up to 80%, which is a massive lift. It's going to be a real game changer for the industry. Crop unit premium support changed across the board. So for individual coverages, such as revenue protection, coverage is lifted about 3% across the board on all of those ranges. If you even all the way down from 50% up to 85%, we saw lifts in all those for optional units, basic units, and enterprise units. So there was a lot of farm in a package outside of the Farm Bill, which is the second time that we've seen this here in the past 2 years. One was last year when ECO premium support lifted from 44% to 65% through the FCIC board. And the reason I bring that up is because these were kind of curveballs to the industry coming outside traditionally what would come in the package of a Farm Bill. So this administration has pushed a lot of support to the farm safety net here in the recent past, which is huge. And those are going to have a kind of a timeline on the implementation. Some of those are going forward in 2026. Some of those are slated later for 2027. Particularly in 2027, our SCO changes are going to be implemented. And what that's going to do is raised the coverage level on SCO particularly from 86 to the upper band all to up to 90%, while the premium support is going to be lifted to 80% starting this year. But the actual changes to the band of coverage, we'll see those next year. But nonetheless, these changes are going to have really big implications for farmers moving forward starting today. Flashing back to ARC PLC and just Title I programs in general, we saw a potential lift upwards of 30 million base acres for those FSA programs, which is huge. For 2025 specifically, producers are going to get paid the higher of either the ARC or PLC. So no number crunching, no math really involved for 2025. We're going to revisit that for the 26 year and going forward and see what that equation really looks like. That program also increased the payment limits from 125,000 up to 155,000. So the last thing we'll call out is beginning farmer rancher. So that's for newer farmers with limited history. There's premium support there. What was historically 5 years running, but now that has been expanded to 10 years. But not only that, in the first, second, third, and fourth year, you get additional premium support beyond what was there before. So in place was 10%. But now they changed that. So in the first 2 years, you get 15%. The third year, you get 13%. Fourth year, you get 11%. 5 through 10, you're going to be getting back at that standard 10%, which is a huge benefit. It eliminates the barriers to entry and really helps out our young farmers out there. So a lot came out of that package. But not only that, there's more. Disaster and economic relief packages from this administration. About the tune of, let's call it $30 billion was issued out in the form of either economic payments or disaster aid. And what you guys would be familiar with is ECAP, right? So that was your economic relief. SDRP, that was your disaster relief. Currently, SDRP has been paid 4 out of the 16 billion slated for that. ECAP has been paid out to the extent of its 10 billion. We have ELRP, which was slated for 1 billion. And next, new on the horizon, on which we have limited details on, just came out late last week, early this week. We have some developments of a new economic program from the Trump administration to the tune of about $13 billion. So we will see what that looks like. What else is going on? Well, everybody knows the government has shut down, and we are 14 days into that. And we haven't had one of these since about 2018, 2019. And that one lasted 35 days. Currently, we're running 14 days. We are optimistic that we're not going to be setting new records, but anything can happen. What's an implication of the government shutdown? Well, certain things are on pause. Your FSA offices are closed. There are gaps in FSA loans, conservation payments. Your SDRP payments are on pause. But the one thing that is continual and up and running and there for you around the clock is your crop insurance. So make no mistake, crop insurance is here day in and day out through government shutdowns. The government does have a plan for this through extenuating circumstances. So unless this shutdown were to last, let's call it 60 days or more, that's when things might change. But as of right now, that's never happened, and we're very optimistic that we will play this par for the course, right? So the government shutdown, last thing that I'll mention here is things that are on pause, right? We mentioned that, but one of the main things that's on pause that are affecting our producers today is ARC and PLC payments. So there's about $2.3 billion of ARC and PLC payments on hold right now. So we're really hoping this Congress can come together, get a budget together, and open things back up. So any comments from the group with regard to current state of things?
I would just add that the livestock insurance programs up to this point have continued to be offered as expected through the shutdown as well.
Yes, which is a huge piece, which is a parallel. It's still risk management. It falls under a slightly different bucket of rules and operating procedures than crop insurance. But yes, Michelle, thank you for adding that. Still ongoing. So let's move on to weather, markets, field conditions, etc. While the government's shut down, we are in limbo here for a lot of USDA reports that producers, market analysts grain traders all kind of rely on. So we are not going to get that October report, it's looking like. So what we have to do is rely on what we have to date. And what we have to date says that we are looking at record yields for corn and near record yields for beans. And if you've been following any of those reports or changes, you'll see that corn acres were planted at a record 98.7 million, which is really big. And I think one of the reasons for that was the ratio of corn to soybean price. Typically when that's over about a 2.4, 2.45, it favors corn. And that's exactly what we saw coming into this planting season, which is why we have so many more planted acres to corn. Now that yield for corn nationally is coming in about 186.7 bushels, which is slightly down from the August projection, but it's still 7.5 bushels above last year's estimate. Now, we all know that revisions come, and while the government shut down, we may get this massive data dump into November and things might change. But right now, that's kind of what we're looking at. So soybeans is telling a very, very similar story. We're looking at about 80 million acres of harvested area, and the forecasted yield is pegged at about 53.5. So just a little bit under the August estimate, but still nearly 3 bushels up from last year's. So we have high yields, which really equates into a supply issue. And there's some things on the global scale that are going to affect how things are done. And the two that I'll point out is China and South America. Now, we all know the news has been buzzing around with Trump and his China deals, but we all know that we need China to come in and purchase soybeans to help alleviate those markets. Consequently, corn, I think globally, if the trade can sustain strong partnerships, then that corn demand globally will remain strong. So I do think that there's optimism with the trade forecast, but time will tell. Now, as far as looking around our neck of the woods here, Compeer, we mainly focus Illinois, Wisconsin, and Minnesota. Now, while we don't have anybody from Minnesota on this call, Brandon, how are things looking in Illinois when it comes to field conditions harvest?
Yeah, many producers have wrapped up soybeans. I think when, I'm in the northern Illinois portion of the state, and soybean yields have been pretty solid throughout. For some producers, could be best ever soybeans, if not slightly below best ever. Many producers are just getting going strong in corn. We're seeing a lot of variable yields, but typically I think we're looking at 10 to 20% below probably last year's yields on corn. So, they pegged that, like you said, the yield pretty high. I likely to see, based upon what we're experiencing here in northern Illinois, we're going to be significantly under last year's performance. So we'll see how, things continue on, but we're noticing that yield to be down.
Mike, what are you seeing out there in northern Wisconsin?
So in northern Wisconsin and even into northeastern Minnesota, and talking to a couple of our agents that are out in the field right now harvesting themselves, we're taking a look at soybeans, and depending on what kind of SPI dirt you have out there, it seems like there's some variable yields with a little bit lower SPI dirt or some sandier ground, and that high profile dirt is typically kicking out some pretty solid yields. So we'll see what soybeans come in at, but I think it's going to be very spotty. I think there's some potential there for like ECO indemnities, things like that. As for corn, across the board in Wisconsin, we're seeing, I would just say, good to great yields. We're starting to get some of our corn out in some of our areas that have focused mainly on beans thus far. But from what we've been seeing and what we've been hearing coming through, whether in southern Wisconsin or even over in that Fond du Lac areas, we're having some pretty good yields so far this year. So with that price reduction, that's something to keep an eye on, especially if you're in a county that's more around that APH level instead of having bumper crops. Something to definitely keep an eye on, but corn yields seem to be pretty solid across the board.
There you go. Michelle, what are you seeing there in southern Wisconsin?
I don't really have any yield information to add or change what the other two said, but yeah, definitely beans have been progressing really well. A lot of people are done and getting a pretty good jump on the corn side of things.
Yeah, it seems to me when I look at the numbers, we started out a little ahead of the gate because planting was mostly favorable across the Corn Belt. But it seems now through harvest, we're kind of right in line with that 5-year average, which is really good. But we will see how these yield forecasts hold up Typically, at least in the recent past, we've seen some major revisions come, especially between the October and the January report. So we'll see maybe some price floors can be found. Yields might not be as high as what we expect, and we could see some price rallies. So that would be good. Speaking of the overall market in terms of what farmers are facing out there, production costs looking to come in at record or near record levels, and conversely, the income statement picture does not paint an accurate representation, in my opinion, because what it's showing is that the net farm income is up about 25% from last year. Well, there's two reasons for that. One is the economic aid. All that, about $30 billion was added to the balance sheet. So it's kind of skewing the picture. And reason number two is the strong livestock markets. So, Michelle, in terms of the livestock markets, how has that been contributing to the bottom line for the producers out there, really creating some economic, support? At least we have one solid area.
Yeah, certainly the cattle markets have really been a bright spot for producers, as we've seen the historically low cattle supplies push prices to record levels. And again, that's very important with some other commodities on the balance sheet really slumping. But the question would be is how long this can continue as far as the cattle markets. It can't go on indefinitely, but for right now, the picture is pretty positive. Things have been good on the demand side for beef as well, but again, that's something to keep an eye on. As prices continue to climb, can consumers continue to find room in their pocketbook for that higher priced beef? And then hogs, the markets have been looking more favorable for pork producers as well. But you've already mentioned some of the trade tensions with China. That also comes into play with hogs as well. So that's something that hog producers are keeping an eye on. Of the three commodities that I'm touching on, dairy finally is a little bit less optimistic, with milk prices being weighed down by the growing dairy herd that keeps raising the bar in milk production, and that's happening both here and abroad. And then the cheese prices, U.S. cheese prices, have lost some competitive edge on the export market. So that's going to be something that we need to watch for the Class 3 milk prices, which affect the large majority of the producers in our trade territory.
Absolutely. Absolutely. Well, as the story's WASD is one of expanding supply, we'll continue to monitor those reports as the government unlocks and we start to get more data in, as we know that about 70% of at least the Midwest is now creeping ever so dry. The drought monitor has been increasing over the past couple of weeks, so we'll see what that does to yields. Lastly, we have a low 70s chance of a La Nina kind of coming through this October-December timeframe, right? So we'll stay tuned because the market's become increasingly more global, right? We could see a winter bounce in prices if that La Nina starts to disrupt production in South America. So moving on kind of to the current state of things. October is a big time for crop insurance because it sets the harvest price. So we'll go into a little bit of a risk management here. Brandon, go ahead and talk to the October price tracking here.
Yeah, here on the corn and soybean side, it's not quite as positive as Michelle was talking on the livestock side with prices, but we're about halfway through our harvest price tracking period near the month of October. Corn is actually looking to end very similar to 2024. About this time last year, many were predicting a 430 to 440 spring price for 2025. But over the winter, we saw a decent rally, getting that spring price for crop insurance for 2025 to $4.70. Currently, the harvest price average is at $4.20 for the October average. So we're down about 50 cents or 11% from the spring. What you can recall, in 2024, we started with a $4.66 and ended with a $4.16, exactly down 50 cents. So very, very similar this year comparing to 2024. When you switch over to soybeans, we started off with a spring price of $10.54, which for many was considered a low when comparing to corn, which, as you stated earlier, Cole, that created more corn acres for 2025. The harvest price is currently sitting at $10.21 on the average, so we're only down about 3% from spring. And in 2024, we did have a 13% price drop, which is much larger, but we started off with spring price in 2024 of $11.55 and ended at $10.03. So like I said, we're sitting there only 3% below the spring currently for 2025.
So just for the elementary, fundamental sake with crop insurance, we set prices predominantly in two times of the year. You get your spring price, which is set through the February as an average of February prices. And then you have your harvest price, which determines your harvested revenue, which is really deterministic in if you have a loss, right? So that is tracked during October, which is why we track it so thoroughly in October to see where we wind up. So knowing where we're at with October prices, we're in harvest. Some of us are already thinking about next year. Brandon, what should producers really be focusing on going into 2026?
There's a lot of things coming in 26. You talked about a little bit before here, increased production costs, low commodity prices, which unfortunately creates tight margins. And, one thing we don't have control of is commodity prices. So that leaves the only variable for change is costs. And, and we're thinking, we got to cut costs. And, toughest part is where do you cut those costs at? Everyone will say, know your break-even costs, which is true to developing a plan. But the important part of this is once you have the numbers, the next steps in making a plan for that success in 2026. Developing a grain marketing plan is a key component, and utilizing crop insurance as a foundation when developing that plan.
Yep, absolutely. And when you're creating a risk management plan, locking in that crop insurance and engaging a marketing plan based off of that really seems to be a key to success. Now that's managing the farm. Now when you take a look at actually doing things on the farm, boots on the ground, knowing your cost, knowing where you stand is important, right? But we've seen an increasing shift towards farming for profitability and not yield. What can you tell us, about that, what you're seeing?
Yeah, I mean, like I said, with fertilizer costs being up, many might think the only way to cut costs is to essentially apply less fertilizer. But could in turn affect your yield and your bottom line. So being more strategic on your application, such as using variable rate technology, might allow for less usage overall, but not limiting your yield. For example, I was talking to a producer here about a year ago that switched to variable rate technology and has prescriptions for all of his farms, and not only for P and K, but for nitrogen as well. And, he was able to cut his fertilizer usage significantly, but, when he came across with the combine, he was able to maintain those consistent yields throughout the field with varying that nitrogen and P and K applications. So in the end, he was cutting costs by limiting its fertilizer, but not limiting across the whole field, only limiting where it didn't need it. So there is ways out there to, limit your costs without giving up yield. Another example, this year, coming this summer, we had low commodity prices. Many producers were trying to make that decision of, do I apply fungicide that just add more costs, $4 corn? Is it really worth it? But data from the field is showing that the yield impact from not spraying is much larger than the cost. So yeah, that was a cost that you could have cut, but like I said, it probably affected your bottom line more by not spraying than spraying. So that's just another example of, knowing where to cut your costs and, making a plan for that.
Yes, absolutely. So switching gears from doing the right things on the farm, let's go back to risk management. So we have a lot of premium support coming through, a lot of packages here. There's a lot more decisions to be made, but I think we have a good narrative going into 2026, coming off the heels of 2025. So what coverages are right for me if I'm a farmer?
Yeah, looking into 2026 and deciding what, coverage level products a producer should be taking will definitely vary since it isn't a one size fits all. But like we stated before, with some changes in premium support for some county products, I expect many to take advantage of those options here in 2026. Before making those decisions, you need to know, how your farms trend with the county, what that county expected yield is, and it will also play a role in this decision. With cutting costs being top of mind for many, keep in mind insurance is most likely is your lowest cost and typically under 5% of your total cost per acre. That being said, I encourage you to keep your individual coverage at an effective level because that is your farm coverage and also has additional coverages such as prevent plant that county products do not offer.
Yep, great points, great points. Let's dive a little bit more into that product suite here. Mike, let's talk about products here, a little bit of past, present, future, and what's going on.
So as we take a look here, the upcoming year, you've got multiple products that you can look at, whether it's focusing on your multi-peril and trying to capture the most for your individual operation, or taking advantage of some of these area plan products that have really taken off and been a focal point for a lot of the news articles and podcasts and everything you've been hearing as of late. So with that attention it's been receiving, our team has been doing deep dives into trying to understand these products, why they're so important, and how they could benefit your operation. So with that, the biggest caveat I need to make sure everybody understands is on these area plan products, you got to look at it kind of like a super enterprise unit for the county. So what I mean by that is the government tracks ever since 2021 using crop insurance production for the entire county to be able to come up to what that county does for a yield. And we know those yields to be expected county yields. So going back roughly 30 years, each county tracks it, and that's how they come up with what you would know as like your APH. And we call that expected county yield. Then conversely, they do the exact same thing, and then they track what is production for that existing year. So in this case, right now, we're harvesting for 2025. Well, according to crop insurance, we have to have those production numbers in by April 29th. So that gives time for the government to key, make sure that they're running analytics on that. And then as they finalize that material in May, it comes out mid-June where we know what those yields end up being, and then we know what kind of a payment we're going to receive. So area plans tend to be a little bit delayed on when you receive your money from when you put the products in place. So talking about these products, and I know you've heard a bunch about a couple of these, but there is one newcomer that came out this year that we want to focus on. We'll start with the past and kind of move to the future. So the first product we really want to focus on is supplemental coverage option. And as all the marketing materials and everything you've seen, we call that SCO. Well, what SCO does is it allows you coverage from where your multi-peril ends up to 86% for this year. So that allows you to get coverage all the way up to 86% by using an area plan, which is what the crop in the county that you're farming in has for an APH, expected county yield, and then also a final yield. So with that one, it's a big benefit if you don't want to leave a gap in coverage and you want to try to capture the most dollars possible for your crop insurance suite. So one big caveat here that I'm going to share as well is what Cole was talking about earlier with that big, beautiful bill is they are now going to move in 2027, this SCO product up to a 90%. That means you're only going to have a 10% trigger moving forward after this year. So that really elevates that coverage to a point where it's more likely to get into those areas with the price volatility we've been seeing as of late to potentially trigger indemnities on a more frequent basis. Currently, SCO, it's one of those where it takes a little bit of a loss to be able to trigger. We haven't seen a ton of losses here the last few years between Minnesota, Illinois, and Wisconsin. There have been a few times where we've seen some poor yields that have triggered it, or we've seen some times where price drop mixed with those has just squeaked into there to help pay off some of the premium. But that's something to keep an eye on. The other thing that we talked about a little bit earlier as well with Cole is we're talking about the ARC elections, right? So when you think about the FSA office and you go in March and you sign up on whether you want ARC or PLC, well, in the past, you weren't able to take SCO if you wanted to take ARC. There were similar products. One uses crop insurance prices. One uses a marketing year average, which the government comes out with. So when taking a look at it, we now get to take advantage of SCO and ARC at the same time. And both of those products are now going to go to a 90% coverage level moving forward. So something to definitely keep an eye on and potentially take advantage of, because that's going to really help a lot of operations to get that trigger as low as possible so that we can more likely often than not start triggering some kind of an indemnity to help offset some of that premium. So with SCO, other things that you want to take a look at is when we look at losses, one thing you need to be aware of is just because it's a county expected yield and we have a county harvest yield does not mean that's what you're going to get paid on. So with these area plan products, those yields are used to determine whether or not you do have a loss and what percent of your loss you have. So what that means is your individual yields are what you're going to get paid your indemnity on. So just because your yields might be better than some of these area plans doesn't mean this product won't work for you, because you're going to get paid on your yields. All that the county yields do is determine what percent of your indemnity it's going to be based on what that county has been harvesting. So something to definitely try to get to understand if you haven't. And one great way to do that is to talk to your Compeer insurance officer. They know this stuff like the backside of their hand. They know it inside and out. They're going to make sure that you are in the right product at the right place at the right time. And we're going to do our best to make sure that we help you through that. One nugget I do want to mention is that multi-peril is still very important even with these products, because as Brandon was talking about earlier, we have a lot of areas in our footprint, especially in that southern Minnesota area, where we see a lot of flooding. And if you have prevent plant, or if you're having to replant, multi-peril is the best way to take advantage of those coverage options so that you can make sure that you can go back in there and put in a second crop if needed, or at least get covered to the point where you can offset some of those expenses that you've already prepaid for so that it can best help your operation.
So Mike, what you're saying is build a good base and then use these supplemental products to capture either shallow losses or gaps where the typical individual coverage stops.
That's correct. Yep. These are ways, and we know that prices continue to go up. We've been monitoring that with margin protection and margin coverage option. Inputs seem to just continue to rise. So sometimes your multi-peril can't quite get you to where you need to be for break evens or even to try to be a little bit ahead. So these are options that can help you get to that point where you can make sure that you have that foundation in place. And then not just that, but gets you to where you need to be able to break even. Because with some of these prices, we can't quite get there with our APHs. So here's how you can gain a little bit more support, a little bit more coverage and liability to help you to make sure that you're continuing to farm the following year.
So Mike, we've touched on SCO. Let's talk a little bit about ECO, which has been kind of the fan favorite here, especially last year, which we saw the industry essentially triple the amount of ECO sales and acres that was put on.
Yeah, this is one of those products that you kind of want to call it the shiny new object with all the changes that have happened as of late. This product's been around since 2021. Early adoption wasn't the greatest. We didn't see a ton of sales those first year or two, but a lot of that had to do with the premium support that we received. So when you take a look back in 21 and 22 and even 23, we saw 44% premium support. So we were paying a pretty good chunk. So let's just put it at a $10 premium. So if we have a gross of $10 premium, which is what the crop insurance looks at, there's farmer paid premium, and then there's premium support that we receive from the government. And when we look at that, those years, we were paying $6.60 out of $10 in premium. So it was costing us quite a bit to get that coverage. Now, what we saw last year was a huge uptick in ECO sales because they increased that 44% to 65%. So now for that exact same coverage, we're only paying $3.50 compared to that $6.60. So that was a huge benefit to the producer. And now moving into this year, we foresee this being a product that is going to be sold more often than not, because the government decided with the big, beautiful bill to take SCO and ECO and increase that premium support to 80%. That means that you're only paying $2 out of the 10, where in the past you've had to pay quite a bit more to get the exact same coverage that they were those years. And with what Cole just mentioned, there was a huge uptick in sales last year. Well, that's because it became a lot more affordable, and now it's even more affordable than it was last year. So this is definitely a product to keep an eye on. So one thing I want to share is how attractive it is, right? It's easy to say this stuff, but it's another when you actually put pencil to paper. So right now with ECO, we have what is known as a 9% band of coverage. So it covers you with a 5% deductible. So you have 5% deductible, and from 95% coverage level, you're able to cover all the way down to 86%, where that SCO stops its coverage. So that means that 9%, so let's use $1,000 for corn. And this is where I ran some numbers here, is that would be a $90 amount of liability for this product. And when running quotes, it's coming in under $9 for that. So that's around a 1-to-10 ratio, a little bit better than that for what you're spending to what you're getting on return for having this kind of a coverage with a 5% deductible. So it's very attractive in today's volatile price environment. And with what I mean by that is taking a look, let's look at the last 5 years, right? So we're going to look at projected prices to what harvest prices look like. Well, corn, 3 out of the last 5 years, the price has fallen from what the projected price was to what the harvest price was. That means that they're already, before looking at yields as a potential indemnity payment, and soybeans has fallen 4 out of the last 5 years. That's an 80% out of 5 years that price has fallen. And depending on what kind of yields the county comes out with, there's a good potential of a indemnity already coming just from the price movement alone. So when taking a look at loss ratios, which like I said, this came around in 2021 is when this product first started. When looking at loss ratios between our 3 states, let's look at Illinois. So Illinois corn in 23 had a 120% loss ratio on the revenue protection version of ECO. And in 2024, it had a 16% loss ratio. So, I mean, even on years where we have great crops, they're still triggering some areas. Minnesota, corn, 178% loss ratio in 23, whereas now we're seeing 146 in 24. Wisconsin was a 135% compared to 112% in 24. So, I mean, we're seeing some pretty drastic loss ratios here. And for $2 out of 10 on premium, I mean, it's getting to be one of those things where you almost really want to look at it for what you get on return. And one thing I will throw out there is when thinking about those loss ratios and thinking about how cheap it is, I mean, it takes 8 to 10 years before you even have to break even with the losses you receive with the premium you pay. So one heavy loss year, you've got about 8 to 10 years where it's pretty much free because you've already been paid for it and you can take advantage of all those years. And just on those 2 years are shared with you, I mean, there's pretty good likelihood that you'll get paid within those years to continue to move that ball down the road. So it definitely is a product that we need to be looking at this year. That 80% premium support is a massive change for us, and it really, really helps us out a lot.
Absolutely. So we anticipate a massive balloon in the adoption of both ECO and SCO. Right now, the industry is about a third. So 1 out of 3 acres, that's probably going to increase, guys, just being realistic to, probably 7 out of 10 acres is going to have at least ECO or SCO or both because of kind of what that looks like in terms of the net returns for the farmer, the loss ratios. The whole gambit is it's really slanted in the farmer's favor right now, which is why we're out there trying to educate everybody as much as possible to take advantage of it, because we want you to have it so that when your neighbor gets that payout, you're not sitting there looking back and going, why didn't I pull the trigger on that?
Well, and Cole, one thing I'll share with you here too is, you heard Brandon talking earlier. Let's look at 25. I mean, we're tracking halfway through the month of October. And once again, I didn't throw out 25 numbers because we're not finalized on these yet. But man, corn price right now is down over 11%. Soybeans are down over 3%. So on an average year right now for corn and beans, you're already at the point where corn's already triggered and potentially close to maxing out. And soybeans are at a point where, down a little over 3%, you're almost where that trigger kicks in without even factoring in yields. So as we continue to move forward, we'll continue to monitor this. But right now, again, 2025 just setting the table. There's potential out there again for some more indemnities in 25.
Yeah, being a producer myself, and I completely understand what ECO offers. It's hard to find a reason not to take ECO. I mean, that's kind of where I'm at is I can't find a reason not to take it.
Yep. So we encourage all the producers out there, take advantage of this. If you're not taking advantage of it, please get with your local insurance officer. Ask us. If you're not with us, come have a conversation. We'll get you all the materials that you need to make these decisions going forward. Because essentially, it's one of those things where it's really hard to time the market, but if you spend time in the market, you're going to succeed over the long run using sound risk management practices, which is exactly what ECO, SCO, these type of products do. So with that, let's shift up into the livestock space here. So Michelle, what's been in the hot spot as far as the livestock coverage goes in the last couple of years?
So really the fastest growing program of the three that we offer is by far Livestock Risk Protection, or LRP. That allows producers to protect themselves against declines in the market on either fed cattle, feeder cattle, or swine. The important thing to remember, though, is that it doesn't limit that upside price potential if those prices increase. So especially as we're looking at the cattle market now, we might want to be optimistic. I mean, it is optimistic. Things are looking pretty good, but no one really knows when that market can turn. In many cases, our producers have a lot of money tied up in those cattle. Obviously, if they bought feeders, they're going to probably have to spend a lot more money than what they're accustomed to spending in the past. And they really should look at protecting that investment, locking in a floor price so they don't take the hit if prices drop. And, like we said before, with other commodities really showing weakness in a downturn right now, beef revenue is likely a larger, more important piece of the cash flow than it has been in the past. So you just really don't want to let that opportunity slip away and get a price locked in that you can live with so that you're in a good position if prices do come down.
Yeah, so these are obviously really vital insurance products for both beef and dairy producers to protect against things like decline in prices, especially in the current cattle market being elevated, right? Kind of in that uptrend. So what all kind of tools are available for producers to protect themselves in this space?
So from our standpoint, LRP is the big one that we would recommend for the cattle and swine producers. There are some new tools in the LRP side that we would want to point out to make sure that they take advantage or are aware of some new opportunities, and that would be coverage that is available now for dairy cull cows. So that's any dairy cows being marketed for slaughter off the farm. And then also unborn calves. This is a new category again as well for those specifically dairy beef cross calves that are sold off the farm within 2 weeks of birth. This is just a huge revenue stream for dairy producers that have taken advantage of this new practice, or relatively new. It's been around for a while, but it just continues to grow, and allowing them to capitalize on that growing value of these dairy beef animals in the beef market. These are revenue streams that dairy producers have just continued to become more and more important, and they really should look at protecting them. And along the lines of just tools that we offer as Compeer, I do want to mention that we have our livestock insurance analyzer. That is an exclusive tool that we make available to our livestock insurance clients to help track coverage opportunities, not only for the LRP program, but also for dairy revenue protection and livestock gross margin. So this is another area where we would encourage you to talk to your Compeer insurance officer for more details on how to get access to that tool, as well as information on the three programs that I mentioned for your livestock operations.
Absolutely. Thank you, Michelle, for that. So with that, today we've covered a lot of ground, right? And this is what Compeer does best, is risk management for both your row crops, your specialty crops, your livestock, day in and day out. So I certainly hope this gave you some perspective about today's landscape, some upcoming crop insurance decisions, and managing risk on your farm. Because Compeer's team is essentially dedicated to bringing value to you, I encourage you to reach out to, your local insurance officer with any questions or concerns, things you learned here today. Maybe that provokes some thought. You can also learn more going out to our website, compeer.com/crop insurance. So with that, thank you for joining us today. We wish you all the best this harvest season. Be safe and be well.
Thank you for listening to Compeer's Ag Edge. You can follow us on Apple Podcasts, Spotify, or your favorite podcast app. For more agricultural finance insights and resources, visit compeer.com. That's COMPEER.com. Until next time.